Recording in progress.
Good morning, good evening, good afternoon, and welcome to the 2020 Master Trader Program with Mark Minervini. I'm Bob Weissman, your moderator. This is day 4 of the workshop, and today's day is full curriculum day. There is no questions and answers for today. There will be time for that tomorrow. On Monday, the live trading day, which does start at 8:30 a.m. Eastern Time. We'll have the room open 30 minutes beforehand, but notice the 30 minutes starting earlier time frame. I do believe the Zoom reminder email may have reflected the 9 o'clock, but it is actually 8:30. Keep in mind, the market doesn't open until 9:30, of course, and what you're seeing pre-market is Mark's routine, which will include things along the lines of his screening. Any real money trading we'll be doing throughout the day. Also, we'll have MarketSmith representative Scott St. Clair here to review the MarketSmith software. Any questions you have about MarketSmith, who is our official sponsor, by the way, for the event, brought to you by Investors Business Daily, is going to be available and showing off the software. And you will be able to ask him questions as well. And also, as a reminder, you can send any emails to bob@minervini.com. Don't type questions into the chat box because they will be lost as comments come in. They just get lost. As a reminder, today's event, there is a very strict no recording of any audio or video and no distribution or dissemination or sharing or posting of this on any forum, social media otherwise, but we do appreciate and have seen a ton of comments from your experience of the event. So we do love to see any of your comments and sharing of your thoughts on the workshop on your social media platforms. So we have been seeing, or I have been seeing a lot of those, and so do appreciate you guys really enjoying it. Today is what I believe is the most fun day of it. It is about 5 hours, about 5 hours and 15 minutes of curriculum. There will be breaks after each session. Today, we will be starting with risk management on page 415, the 2 sections that we are going to be passing, which will be covered tomorrow, daily routine, and putting it all together. Those pages will be reviewed and discussed tomorrow. So 404 to 414 will be tomorrow. We'll be starting with page 415. And also, just as a quick reminder, the replay of today's session will be tonight at 6 p.m. Eastern Time. The room will open 30 minutes beforehand using the same username, login credentials as you have been using for the entire workshop is what you'll use for tonight again, as well as tomorrow's live trading day. So with that said, let's get started with day 4 of the 2022 Master Trader Program, page 415, risk management. Let's get to Mark and Mark for getting started.
Okay, everyone, welcome back. 2022 Master Trader Program, Super Performance Workshop. I'm here with Mark Ritchie. We're on day 4, and you should be in the second volume of the workbook. We're going to move to we're going to the risk management section, and that's going to be on page 415. Let's make sure, Mark, you there?
I am. Can you hear me okay?
Yep, I can hear you. Great. All right. So just real quick, we talked about reference points, defining what specific entry point analysis is, how we're using all this information to come down to a very specific buy point. We went through stage analysis, the 4 stages. We want to be in stage 2, of course. We did relative charting against the market, how to spot leaders, VCP, entry points, looking for that tightening in price on the right side, going through those iterations of contractions, fundamentals, looking for earnings, sales, margins. I showed you a bunch of ways that I slice and dice that information. And then we also talked about sell rules, selling at the strength, warning signs, and so forth. Now, all that boils down to, if you don't get this next part right, risk management, and you're not operating within a framework of risk first, you can pretty much flush everything else down the toilet because it all comes down to risk management. And that's why this is a really super important section that you need to pay very close attention to. And it's going to be, it's long, it's deep. There's some areas that, you may get lost a bit, and there's other areas where you may get bored. I'm not sure, but it's all really important stuff. I want to start off with just talking about what this first slide says. Stocks are not like mutual funds. They don't have a manager. You're the manager. You have to manage the risk. If you don't manage the risk, it will manage you, and you won't like the outcome, I assure you, ultimately, at some point in time. Now, currently we're in a bear market. A lot of you can relate now that Facebook's down, 75%, and some of the biggest cap names have come under significant selling, and many of the growth stocks are down 80-90%. We talked about the 50-80 rule. This particular bear market has certainly put an exclamation point on that rule. So you can probably relate to how important it is to manage your risk, cut your losses, and so forth. So I want to start off with it. Again, some of these things I talk about in my book, you may have heard me talk about before, but it's real important that we set some expectations or some reference points here in addition to what we've already discussed. I want you to have some perspective here. The loss adjustment exercise, this is something that Larry Height, who many of you know is in Second Market Wizards book, was one of my mentors, or at least someone who influenced me. His interview in that book and his style influenced me quite a bit. I've become great friends with Larry and talk to him all the time. The way that I originally became acquainted with Larry and became friends with him is he actually called my office. He talked to Bob Weissman, called and said he was looking for Mark Minervini. Bob said, "Who is this?" He said, "Larry Height." Bob said, "Larry Height from Market Wizards?" He said, "Yeah." He says, "Okay, what can I ask what this is about?" He says, "Well, there's a page in Mark's book, and I loved it so much that I made copies of it, and I sent it to my grandchildren, and I sent it to a bunch of people in my family, and I want to talk to them about it." It was this particular topic or this exercise in my book that he was referring to. So and I gave him a call, and we had a long discussion about this. And he did a similar early on. He had a similar experience. It did a similar exercise with losses of arbitrarily cutting his losses and doing a random generator where he found that it was, if you cut your losses at a certain point, it became profitable. I also talked about this in my Market Wizards interview with Jack Schwager about randomly, setting a stop loss and even throwing darts, at a Wall Street Journal, I think I said in that interview. So real quick, just want to go over this again, because like many of you, I did not start off trading well, and I had a lot of big losses in the beginning, and it was due to looking back and studying them. It was due to holding losses and not accepting them when they were small. I did embrace the idea of loss cutting pretty early on, but I didn't do it religiously. And I'd have every now and then I'd have a 25, a 30%, sometimes even a 40 or a 50% loser. And those took this big toll on my portfolio that I didn't even realize at the time how powerful, minimizing my losses were. But I was very interested in understanding it. So what I did was, after I had a period where I wasn't trading very well for a couple of years, I was down about 12 or 13% in my portfolio. I said, it would be interesting to just see, what if I was 100% religious and I just cut every loss at an arbitrary 10%. What would that do to my performance? Would it have made much of a difference? So I went back, I took all my trades, and I made all the losses that were bigger than 10%, 10%. And I also took all the losses that were smaller than 10% and made them larger and made them 10%. So I just made a 10% cutoff, just an arbitrary number. Well, the results came back, and I would have been up over 70%, close to 80%. So I immediately thought I must have made a mistake. That obviously it couldn't be that severe from such a small change. And I ran the numbers again. Same number came back. I ran them again. Third time, same number came back. The number was correct. So then I adjusted survivorship bias, and I might have been knocked out of some names by choking them off, and I adjusted for all that, and it was about the same. It was just maybe a little bit less. I'm still above 70%. I said, man, this is incredible. This is so powerful. And the light bulb went off. And that was at the point at which I just drew a line in the sand. And I said, that's it. I'm drawing a line in the sand. And I'm never, ever going to let a stock, unless it gaps and there's nothing, it's out of my control. I'm never voluntarily allowing a loss to get larger than X. And I drew that line at 8%. So in this example here, this is a hypothetical example, but you can see there's 20 trades, and in the original account results before they're adjusted, you're down about 12%. The average gain is 18.4%. The average loss is 15.9. Batting average is 50-50. It's just one trade's profitable, one trade's not profitable. And it doesn't matter the order you do this in. It could be in any order. Compounding is going to work no matter what order you do it in. So now adjusting to 10%, what that did was that took that 15.9% loss and made it 10. So the only thing that was changed was taking 5% off that loss. And that is what created this result of going from minus 12 to almost 80, just under 80%. So you might want to do this if you're someone who holds losses, you've had trouble in your account, you may want to do this exercise. It could be very eye-opening when you see the power of managing the risk. And the reason why we're even starting with this, and we're going to start with a couple of slides of things that you may have heard before or concepts you may have heard before, is because we really have to pound into your head and get you to embrace the fact that this is something that can't be compromised on ever. Like, this is the whole ball of wax. This is why Mark Ritchie is Mark Ritchie, and why he's got the results he has, why I have the results I have, why Paul Tudor Jones has his results, Bill O'Neill. You can name any trader that's a great trader, a champion trader, a legendary trader, and you're going to see that across the board, the thing that they really have in common is the managing the risk. That's the part that they focus on first. And everything I do in the market starts with a risk first approach. I always look at risk first, and if the risk isn't acceptable, I don't take the trade no matter what the potential reward is. Now, this is certainly a chart that many of you have seen before, and talking about losses work against you geometrically. Okay, some of you may have not understood this or been seeing this type of diagram, but when you have a loss and one of the reasons why we want the losses to be small is because mathematically, after you get above a certain point, the math starts to work against you, because losses work geometrically against you. What that means is that the larger the loss, the more work it takes to recoup the loss. So when you're down 5%, it only takes a 5.26% gain to get even. 10% takes an 11. It's about apples to apples. You get down 20, it now takes a 25% gain to get even. You get down 50, you have to double now. It has to be a 100% gain. Stock goes from 100 to 50. For it to go from 50 to 100, it has to double. So now it's working way against you. And God forbid you're down 90%, which some stocks are down that now. If you held it down, it's got to go up 900%, or your portfolio would have to go up 900% to get back to break even. And I'm sure you haven't had that many stocks that went up 900%, right? So not something that you can do regularly. So there's three things that you have to right up front know about losses. Number one, you're going to have lots of them. All right, that's trading is about having lots of losses and taking small losses. You are not going to be correct all the time. As a matter of fact, you're going to be correct probably half the time. Mark, you've had an incredible track record and your drawdowns have been amazing. How often are you right versus wrong? What's your percentage of profitable trades?
Yeah, I'm right. Yeah, I'm right about just under 40%. So I'm wrong. I'm wrong more than I'm right. And just to hammer home a couple of points, one question I get all the time is, what did your dad teach you about markets? And if there's one thing he kind of pounded in me in the same way Mark and I are going to try and pound this in everybody here, is that losses are a part of the game. And if you don't learn how to take them when they're small, they will get bigger. And if anybody's figured out a way how to avoid a big loss, rather than taking it when it's small, please tell me, because I'm all ears. There's no other way to do it. And just one quick story, after the first master trader program I went to, won the triple digit challenge. Afterward, I was speaking with another gentleman who had attended the first one with me. I think we'd sat, a couple of chairs apart, and we were just talking. And I said, well, how's your performance been? Because the market had been a good period, obviously. I was up over triple digits, and he said, I haven't done very well. And I said, well, why? And he goes, I just held on to a few too many losses. It doesn't take holding too many, or just this one time type trades, as Mark will get into, to really destroy what is otherwise a great strategy and approach and an equity curve.
Yes, and we're going to dig into the math, and we're going to show you the math behind this, and really, it's going to be quite eye-opening. So, as Mark said, if you can, 40 years of doing this, I haven't found another way to protect myself from a large loss other than taking a small loss before it becomes a large loss. And so that's really the only protection that you have. I mean, you could buy puts and hedge and all these other things, but that's adding risk. You could lose on both. So the main thing is, you got to remember you're going to have losses. Losses work geometrically against you, so you can't let them get large. The only way to avoid a large loss is to take a small loss. Now, not only are losses important just mathematically because they work against you geometrically, but this is all about everything that you do as a speculator, as a stock trader, as an investor. It is based on risk versus reward. So, for instance, and this goes back to the one of the number one rules that I have, and that is to always be getting odds on your money. And the real thing to understand about the market is that it's not like poker or craps or blackjack where the odds are fixed. You can't really change the odds. You can only exploit them, or maximize your chances by playing correctly. But the odds are the odds. In the market, you don't really just get odds. Like, you don't know the odds, so you've got to make your odds. The way you make your odds is by controlling your risk. One of the few things that you have direct control over in relation to your reward, your potential reward. We're going to talk more about this and how you measure that and so forth. But think of it this way. You've got two traders, right? You got trader A. He buys a stock at the same stock, same spot. Or same type of stock setup, let's call it. And stock comes out, meets his criteria. We talked about VCP, breaks out of a VCP, turns around, goes down 20%, and then turns up and goes up 20%. He sells it, takes a 20% profit. Trader B buys the same type of situation, breaking out of the VCP, sets a stop at 5%. Stock turns down maybe 4%, doesn't hit that 5%, goes up 20%. Didn't allow it to go down, more to that 5%. And if it went down to 5%, would have taken the loss at that 5%. So now, how we operate with trading is we work with what we call R's. R's are a multiple of your risk. So trader A has got even money, right? He risked 20% to get 20%. So if you were right, let's say Mark just said he's right less than 40% of the time, about 40% of the time. Let's call it 50. All right, that's what most traders doing this that are good fall around 40-50%. So let's call it 50. Well, if I give you a coin, you flip it and you get $1 on heads or $20 on heads, and you lose $20 on tails, it's a 50-50 proposition. You're not making any money, right? So you got to get odds. You got to get odds on your money. But if you're risking $5, and then when it lands on heads, you get $20. Well, now being 50% correct will yield you a fortune. Matter of fact, being 35 or 40% correct, you would make money. So that's, you always have to think in terms of odds. So here's just a overlay over a stock chart where trader A buys, just breaking out of a chart. So maybe it's just started into a stage 2 uptrend. Everything's going to be applied to what we already previously talked about. And now that stock runs up from there, doesn't hit that 5%. If it does hit the 5%, he's out at 5%. But if he's exposing himself to stocks with the potential to go up multiples of that, well, if he captured that 50%, took that 5% risk, he just made 10 R's, got 10 times the money that he risked. Now, not all gains are created equal. The outcome, it doesn't justify the way you got there. You have to know, how did you get to your result? Because trader B, you've got some traders that buy stocks, they hold them down, they hold the stock down 60% and then sell it up 20%. They actually have an inverse risk reward relationship. But let's just say in this instance, this trader B buys it, he holds it down 50%, then the stock goes back up and he sells it up 50%. Well, again, they both made 50%. But I can assure you, over the long term, trader A is going to make much, much more money, and trader B is going to get in a lot of trouble someday, because trader B is only getting even money. Trader A is getting a multiple. All right, right. In this case, 10 to 1. But let's just even say on average it was 2 or 3 to 1. So they're getting odds on their money and keeping the losses small. Who's to say that that 50% decline is going to turn into a 60 or 70, like we've recently seen in Facebook and many of these growth stocks in this bear market? That's eventually going to happen. So it's a certainty at some point. So now, the whole point of this is that the result does not justify the means. And this is one of the ways that I try to illustrate this point. Think of two people on the side of a road, right? And your goal is to make it to the other side safely. So the first person closes their eyes, plugs their ears, runs into heavy traffic, and makes it to the other side. The other person looks carefully both ways, listens carefully, goes across a lightly trafficked road, and gets hit by a car, gets killed by a car. Now, who made the smart decision, right? The first person, I guess, got lucky getting across there, right? But here's the real question. What if I would say, I want you to bet on which person would make it to the other side, and it's going to happen over 100 times. They're going to do it 100 times. Wouldn't you feel that there's a near certainty that the person who's looking carefully is going to make it across more times than the person who is closing their eyes and closing their ears? So that on that any one event, that does not justify, just because he made it safely, doesn't mean that he did a smart thing and made a smart move. Well, the key to remember is you're not going to make just one trade. So the probabilities are going to eventually, they're going to surface, and everything's going to work out mathematically. If you're in low probability situations, if you're not getting odds on your money and you're laying odds, well, you're going to lose money. You have no edge. So you have to have an edge, and you have to always realize that it's over time. It's over many trades.
Mark, I just want to add, that's something I think, this is something I ask myself all the time. What if I did this 1,000 times? And I think if you're new at this, especially, you want to be asking yourself this, because where we're going is eventually it's these stats and the math is going to work its way into your actual decision making and into your actual trading. That's where Mark's taken us here. But the idea being, okay, if I ask myself if I do this 1,000 times, it's going to keep me from holding just one loss. It's going to keep me from chasing extended stocks or buying, sloppy breakouts. Because if I do this 1,000 times, I realize I'm not going to be ahead where I want to. It's going to help me continue to be more and more and more refined in my selection criteria.
I'm going to give you a bunch of examples, metaphors, and so forth, and then I'm going to show you a lot of math, a lot of statistics, and then all this is going to culminate to a point where I'm going to change the way you think permanently. I promise you that after this section, you will never look at a trade. You'll never trade the same ever again, psychologically and hopefully physically. That it'll translate that you'll be using this stuff, and you'll let this make its way into your trading. But I assure your thinking will be transformed. So, but I've got to give you a lot of different ways to look at this and make a lot of examples. So bear with me. I'm going to get you there. One of the reasons that we want to get odds on our money is because what it does is it actually builds in a protection mechanism by what I call building in failure. So in this table right here, think of it this way. If you're getting even money, right, and you're 50-50, well, then it's break even, right? You get $1, you lose $1, you're 50-50, it's break even. Minus commission, you would lose. But if you're laying odds, all right, you're giving laying 2 to 1. Well, now just to break even, you would have to be right 67% of the time. If you're laying 3 to 1, so let's say your average gain is 5%, your average loss is 15, you're laying 3 to 1, you'd have to be right 75% just to break even. Right? You don't even start making money until you're above 75% batting average. But let's look at it the other way now. Let's say we're getting 2 to 1, right? We cut our loss at 5% and our average gain is 10%. Now we could be wrong 67% of the time. We only have to be right 33% of the time, 1 out of 3 times, and we're still not losing any money. We're not getting into any trouble. And if you move it to 3 to 1, let's say you were getting 15% on your gains on average, and you're keeping that loss at 5%, you're right just 50% of the time, you can be wrong now 75% of the time, and you're not losing any money. You're not getting into any trouble. Above 25% correct, you're making money. So imagine if you're 50 or if you're 60 or 70, you'd be printing money. So the whole concept is to always get odds on your money. Always get odds on your money and build in as much failure as you possibly can into the system. This is the opposite of what a lot of people not only do in their system, or when they build a system, they're looking for profitability, the percentage profitable trades, but also psychologically. People don't like to lose. Just taking losses is difficult. But when you look at it this way, you start to realize that small losses and building that failure into your system gives you a lot of protection, and you look at it in a whole different way. Now, another thing that we have to start off with is to understand what is it that you control and what is it that you don't control, because you only control a few things, right? You control what you buy, you control when you buy it, how much you buy, and when you sell. Those are the 4 things that you control. What you don't control are pretty big things, all right? How much the stock goes up. Once you buy it, whether it goes up or not, or how much it goes up, is completely out of your control. And how often that you win versus how often you lose, whether the stock becomes profitable or not, once again, it's out of your control whether that stock becomes profitable or not. So how do you gain control in an environment of such uncertainty? How do you gain control? By not relying upon it, by not relying upon those things too much, and really relying upon what you do control, and the things that you don't control, you want to remove your reliance on them. And that's what we call building in failure. When you're not relying upon that high batting average and being right 80% of the time. I have a friend, as a matter of fact, he's in one of the Market Wizards books, sort of a legendary trader, and his risk reward is inverse. All right, he has a very high batting average. He's right about 80% of the time, but his average gain is much smaller than his average loss. He did well for a number of years, but when that edge was lost, when he had a couple tough times where the batting average came down, he blew up. He had when I say blew up, I'm talking about, maybe not bankrupt into zero, but a huge decline, a big giant drawdown that was very damaging. And that's because when you rely upon that high profitability, or that high batting average, when you lose that edge, it's much more damaging than if you lose your edge in the risk reward ratio and you build in that failure. I'm going to show you some math here and show you how that works. So again, just 2 hypothetical traders. Trader A has got an average gain of 15%, an average loss of 5%, right? So that's 3 to 1. Right, that's getting 3 times your money. Call it $15 on heads, $5 on tails. But this time the coin's bent a little bit, right? The batting average is only 40%. So at 40%, that means that's still a 2 to 1 trader. So if you were 10% gain, 5% loss, and you were 50%, obviously 10 divided into 5 would be 2 to 1, right? Well, if you would take 15 divided into 5, it's 3 to 1. But now we've got to adjust it for the 40% batting average, right? We're only right 4 out of 10 times. That also is a 2 to 1 trader. Like you're net a 2 to 1 trader. And that's what we call the adjusted win-loss ratio. It's adjusted for batting average. So bottom line, you take that trader and he does 10 trades. He's got a 28% return on investment. That's what that would compound out to. All right, let's take the other trader that's sort of like my friend, where his loss is larger than his gain. In this case, we're gonna make it a 2 to 1, right? 2-to-1 loss versus gain, which will be a 0.50 if you divided the gain by the loss. But we're going to take the batting average way up, 80%. This trader is right 8 out of 10 times. Well, it's still a 2-to-1. And if he did 10 trades, you're still getting about 28%. So you might say, well, what's the difference? If you're still going to get there, well, there's a big difference, because at some point, your edge is going to be pressured. You're going to lose your edge, and there's going to be times where your strategy doesn't work very well. We'll talk about that later and why that's important. That's actually a good thing. So what we're going to do now is we're going to sort of clip the wings of the edge of these two traders. So we're going to just cut their edge in half. Basically, trader A, his edge is not in the batting average, because his batting average is below 50. He's actually losing more than he's winning. But the edge is in the risk-reward relationship. So we're going to take that risk-reward relationship down from a 2-to-1, or actually, I'm sorry, from a 3-to-1 down to a 1.5-to-1 with the same 40% batting average. Trader B, we're going to keep it like it was, although we're going to now take the batting average and we're going to cut it down and cut that edge in half and take it down to 40%. Now look at the two traders, right? Trader A is about flat, loses 2%. Trader when losing half of the edge. Trader B loses 50%. And this is where, like I said before, I know people that have blown up their accounts when they've got that high batting average, but the batting average fails. So let's say that maybe you feel I'm being a little unfair on Trader B. Okay. So what I'm going to do this time is I'm going to penalize Trader A even more, and I'm going to penalize Trader B less. So we're going to still cut the edge in half, but now we're going to take the batting average on Trader A and make it 30%. Now he's only making a profitable trade 3 times out of 10. So in 10 trades, he would lose 13% return on investment. All right. Certainly, I wouldn't be happy with that. And that's we're not looking to go into the negative, but at some point, yes, you might have this type of result. And we want to build in as much failure as possible. So when things go wrong, we're going to minimize that downside. Well, Trader B, we're gonna cut that edge only down by a quarter, just from 80 to 60, which I can assure you that if you're relying upon an 80% batting average, you will have periods where you're running at 60 and probably even 50 or 40 or less. So now, again, penalizing Trader B less and penalizing Trader A more, still Trader A outperforms Trader B by quite a margin. And instead of 13% decline, you're down 20% with 10 trades. Okay, so let's take it a little bit further here. All right, let's try another permutation. So now we're gonna take the average gain and we're gonna actually increase it. Okay, and we're gonna bring it back to that original 40% batting average that we talked about before, because that's more realistic. Where you lose your edge, you're gonna lose your edge by half, and we're gonna cut the edge in half for Trader A, but also keep that batting average down to that low 30%. Still, Trader A loses 13%, Trader B loses 34%. So you can play with these numbers. We've looked at them ad nauseum in every kind of way you can think of, but a high batting average is not where. Now, no, don't get me wrong. If you love to keep your reward to risk high and have a high batting average, that's the best of both worlds. And at some point, you will run at a high batting average and you'll be managing that risk to reward, and that's where you'll make a ton of money. But there's going to inevitably be times where things get tough, and you've got to build that into your system. This is what I call building failure into the system. And that's why I would rather have a strategy that I made money being right 1 out of 10 times. I'd rather lose 9 out of 10 times and be able to not lose money than a strategy that had a 90% probability of winning. Most people would say, oh, I want the 90% probability. No, I want the one that I don't lose any money at 90% being wrong, because I only got to be right 20% of the time, 30% of the time, and I'm making great money. And if 40 or 50, I'm printing money. So building in failure, Mark, in your, and I could just say also in my own experience, when things are going, when we're in a bear market and trades aren't going very well, I might be down in the 20s to 30s, my batting average. But when the market's going really well, I'm sometimes in the 60s, and even I run in the 70s for short periods of time. What's your range, Mark, as far as when you're doing well, what could we expect for a batting average on the upper end and on the lower end when things aren't going so well?
Yeah, very similar. And this year's been a good example. My batting average has been in the 20s. But because I've built in that failure, I'm keeping the losses, contained. It's the drawdown differential, between these two, because tough times are inevitable. So what we're really saying is, when the tough time comes, how bad do you want to be down? And relying on the higher win rate is often a recipe for much bigger drawdowns. And the other thing I would just add is, I think often folks that are new to markets, they don't like how it feels to be wrong. I mean, let's be honest, it's not always fun taking losses. You can be disciplined about taking losses, and you don't have to enjoy it. But it's just part of the business, where folks often think, well, if I can just find a strategy where I'm right all the time, and that will fix the problem. And what I'm hoping, and I know Mark is trying to hammer home, is that's the opposite of what you really want to do. You want to build in enough failure to where, things can be running poorly, and you're barely down. So then when they inevitably are good, you're into new high ground in terms of your account, just like a good stock, and making money with relative ease.
Yes, and as Mark said, and that was where I was going earlier, is that most traders and investors have a very hard time with a strategy that has a low batting average, because it feels like you're losing a lot. And it's the number of occasions of losing versus winning that's psychologically difficult to deal with. And what we're trying to do here is get you into a mindset that you start to see the math behind this. And when it starts to make sense and you understand, then you start embracing losses, as long as they're small. You realize that small losses are part of the business, and the risk is being paid for by the reward. And by building in that failure, you're actually bulletproofing your strategy. You're creating this protection of having a drawdown. Let me move on here. Basic rule that you have to always remember is that losses are a function of expected gain. So, for instance, if you're a day trader, your expected gain might be, 1 or 2%. You're scalping, right? So your losses are going to have to be much smaller than someone who's swing trading and maybe has a 10, 12, 15% gain normally. And depending on what your batting average is, of course. So the holy grail of trading, okay, or any speculation, you've got to make, even any business. When you're in business, you buy merchandise and you've got to sell it for more than you paid, right? It's that simple. You still have to manage the risk reward relationship. Stock trading is no different than any other business. The stocks are the merchandise, you're buying them, and in the hopes that they go up higher, more than you paid. And you've got to manage the downside. And I think Bill O'Neill used the dress, the red, the blue, the yellow dresses. A retailer buys blue dresses, red dresses, and yellow dresses, and the yellow dresses aren't selling, and the red dresses are selling great, and the blue dresses are okay. What do? They put the yellow dresses on the clearance rack, they mark them down, they get rid of them, they buy more of the dresses that are selling. So that's how you have to think of your portfolio. And the holy grail, the thing that you have to always be managing and thinking in terms of, is your average gain times the percentage of winning trades divided by your average loss times the percentage of losing trades. That gives you your adjusted win-loss ratio. That goes back to what I was talking about previously, where 15 divided by 5 is 3-1, but netted out for 40% batting average is 2-1. That's the formula. That's the holy grail formula, right? So taking these, what I call the trading triangle, the 3 elements of that formula would be your average gain, your average loss, and your batting average. And this is what creates your edge. This is what creates the edge, where if you have your average gain is larger than your average loss, or even in the instance of trader B, where the average loss was larger than the average gain, but the batting average was high, right? That would give you an edge. And that may be, that may be the route that you end up going. But as I just pointed out, if we can get the lower batting average and maintain our edge in the risk reward relationship, well, then we build in a lot of failure. And when that batting average improves, it turbocharges it, right? So let me show you a few things that.
Mark, just to highlight that last
go ahead.
slide too, I just want to, if you're new, I want to encourage you to think in these terms. And there's been a lot of traders over the years now who've reached out to me. And one of the first questions I usually ask them is, well, what's your average gain? What's your average loss? And what's your batting average? And usually they don't know them at all. And we'll get to that, I think, in the post-analysis section, if I'm not correct, Mark. But the idea in terms of just, you want to make this almost an axiomatic part of the way you think, to again, letting these numbers and the math and eventually work into your decisions, which is where we're going next.
Right. And that is to know the truth about your trading. That's what Mark is saying. That's where we're going next, is to, the first step is to know the truth about your trading. Get your head out of the sand and take a look at your numbers and find out where you're at. That's the very first step, to see where you currently are at. And that's going to come in the form of, what you want to look at is your average gain, your average loss, your percentage of profitable trades. You also want to look at your largest gain. I like looking at my largest gain and my largest losing trade in any 1 month, closed trades. And then I look at what my time that I held on average, my winners, versus the time that I held my losers on average. Okay. And I plot those monthly. This is something you can do in a spreadsheet. You can build your own Excel spreadsheet. We actually have a program that does this for you. You enter your trades and it spits it out and slices and dices. It's called Trading Logger on our MPA platform. But this is what I refer to as the instrument panel. So it's like if you were flying a plane, you've got all these instruments, right? The horizon, your speed, your altitude, those all have to be in a certain relation, or the plane is going to crash. The plane is flying sideways or upside down. So these numbers allow you to assess if you're flying the plane upright. So let me tell you how you would even analyze these numbers. And the reason why we're again, I'm going to go over all this math with you and keep circling back to this, is because we're going to try to get you to where we're going to get you there. We're going to get you to where you're thinking in terms of this math and these spreadsheets, and they're going to make their way into your trading. The next time you make a trade, all this math is going to be in the back of your head, and it's going to help you make better trades and better decisions. And I'll show you that in just a little bit, how we're going to get there. So first thing is average gain, average loss. And if you plot these monthly, not only do they tell you how well, during the month you've managed your losses versus your gains, they also give you good information as far as how good the market is. I mean, if you're seeing that your average gains are really small and your average losses, you've got a lot of them, your batting average is low, it usually means that the market's not too good, or you haven't, followed your discipline very well. It can only be one or the other. So another thing I like to look at is the largest gain and the largest loss. And when you look at largest gains and largest losses in any, one period, like maybe a week or a month or so, yeah, you might get torpedoed on a stock. Maybe a company comes out with an earnings report and you get nailed on it, and you take an outsized loss. But when you look at it over a period of 6 months or 12 months, and you run an average of all that, in this instance, you can see the average over a year is 18.43% for the largest gain, 8.37% for the largest loss. That number doesn't lie. If you're consistently having or averaging larger losses than your largest gain, you're not managing the risk reward relationship. You're not managing the risk reward relationship well. And then to take it to a step further is to look at how many days you're holding your losses to how many days you're holding your gains. And when that's inverted, in this case, 26 days for the gains, 11 days. See, all this is basically a ratio, a positive ratio, just like the reward to risk. We want all this to have a positive ratio. We want to be basically riding our winners, bigger winners than losers, holding them longer than our losers. This is what I call the stubborn trader indicator. So when you see the largest gain is smaller than the largest loss, and you see that your time that you're holding your losses is longer than you're holding your gainers, on average, over a period of time, 6 months, 12 months of trading, it means that you argue with the market. You don't take your losses and you hang in there and you hold them. You're not letting your winners ride and cutting your losses quick. You're doing the opposite. And this is where you really see the truth about your trading, and you know exactly where you are and what needs to be fixed. And this is the starting point. Now, all this is going to distribute. If you were to take your trades, and this is another, we also have this on our program, the trading logger. I'm sorry, I'm getting a brain fart there. On our trading logger software, where you put your trades in, and it will distribute all your trades over a bell curve and then chop them up into these increments. So now you can see where are your 0 to 2%, 2 to 4, 4 to 6, and so on. How many trades do you have in those slices versus the loss side? And basically, it's just a distribution curve of your wins and your losses. You can do it however you want. You want to make it a little bit more granular, you can go in 1% increments, however you want to do it. Again, you can do this all in a spreadsheet, in an Excel spreadsheet. Now, the key is that you want to have a skewed bell curve, right? If the bell curve is perfectly distributed and even on both sides, well, you're a break-even trader. Your losses are basically equaling your gains. So you want that to skew on the right side. But one of the main things about this analysis and letting your trades, putting your trades on a spreadsheet, looking at a bell curve, actually physically seeing your trading, is that when you're in the trading environment and you're trading, at least the way I think about it, I say to myself, the stock is starting to get down there and it's getting to 4%, 5%, 6%. I start to think, I don't want to see that. I don't want to see that trade sticking on the left side of my curve. I start thinking of my bell curve, and I want this to be clean on the left side, and I want that right side to tail out. I want outliers, right? That's a skewed bell curve. I want as many standard deviations to the right as I can. So thinking in math like that, I automatically know, okay, my average gain is 10%. Well, if my loss starts approaching 10%, my plane's going upside down here, right? I've now got that reference point. So very important. What I call is building the wall right on the left side here. I have an uncle point, and that's at the 8% mark. That's it. I'm not going to allow a stock to get through there unless it gaps, and there's nothing I can do about it. And you might have a few outliers that get through there, but the goal is, of course, is to let the right side develop and cut off the left side. This is what we call creating asymmetric leverage. That's when you put yourself in a situation from this point, right? This is the breakout, right? From that point, there's this much potential on the upside. And even though there may be, let's call it equal potential on the downside, you are clipping it off. You're cutting that downside off. So now you have now created asymmetric leverage. You've made your odds, right? You're not, because you're not going to get the odds. You're not going to necessarily get those odds. This is a moving target. And with stocks, some stocks are going to go up X amount. Some stocks are going to not go up much at all. Some stocks are going to go down. But so the only thing that you have are your own results and what you can rely upon based on what your strategy has produced. And the whole idea is to get as close of an idea as you can of what you can average on the upside. It doesn't have to be in any one particular trade. It's what happens over time, right? That's why I'm giving you these examples of guy walks across the street 100 times, not just one time. So for instance, if you were to play aces and you lose with aces, well, doesn't mean you stop playing aces, right? If you play aces 100 times versus a guy who plays a pair of twos, your heads up, you're going to win. You're going to win over time. So this is all about what happens over time. All right.
I want to add, Mark, too. This is on one of these charts. I just feel like, folks, you've got to burn this one into your brain, because, as you look at this, you can see, around sort of the peak of the distribution and the meaty part, it kind of, everything comes out in the wash, where everything is, if you don't wall off that left-hand side and allow your right tail, there's where all your profitability really is going to lie, because a lot of those, plus and minus fours, they tend to rinse out. But if you don't build that wall, the only thing you should have, say past 10% is that occasional gap, or, once a year, every couple of years, something, sort of blows past a stop that you can't avoid. But even then, I think I've done mine before. My worst single trade was a 30. Well, I've got some that are out 80, 100. I've got, my tail goes way out to the right. And that's where all of your profitability is ultimately going to lie, in your ability to wall off the left-hand side of the curve and push things out to the right.
Yeah. And so this is going to all culminate to, everything comes down to math. All right. It's all going to come down to math, all the charts, all that stuff. That's great. But the bottom line is we have got to make more money on our winners than we lose on our losers, and net it out by how often we're right is going to create our edge. And this is another result-based assumption forecast, is another calculator, if you will, that we have on our platform that you can put the numbers in. And I've played around with this for years and years. I had this in an Excel spreadsheet. I know a lot of people I've seen on Twitter have read my book and they developed this on an Excel spreadsheet. It's pretty easy. What this allows you to do is put in your, say, a goal. Say your goal here is desired returns 100%, and then put in the numbers that you're getting on your trades. So you look back at 100 trades that you did, you got 12% on your winners. Your losers were average 6%. You're right 50% of the time. Well, that's going to tell you now what it's going to take to get to your goal, right? How many opportunities you're going to need, because this is a big part of the equation. And you look over here, 134 trades are going to be needed to reach your goal, right? So this just tells you what your profitability is. You're gaining, in this particular example, $200,000 portfolio, 25% positions. You're gaining 6,000 on your winners on average, losing 3,000 on your losers, 2 to 1, right? So now turn that over to get to that 200,000. You have to do that 134 times. Well, if you're a day trader, that would be doable in a very short period of time. I have friends that are day traders, some of them do thousands of trades in a day, which sounds unbelievable, but that they actually do that. And then with my type of strategy, I usually trade anywhere between 150 and 500 trades a year. So again, this would be very doable for me to get to that 100% return with this type of position sizing. So these are numbers you can play with as far as forecasting as to what your current results, where it would get you, and then contrast that to where you're at, and then you can see what needs to be improved. If you've got a 3% average gain, and even if you had a 1% average loss, well, you'd have to do a lot of trades, right? You have to turn that over quite a bit. And is that realistic? So, and then if your numbers are inverted, obviously you see that you'll have to improve, maybe holding the stock longer, having better stock selection, and improving that average gain. So the whole idea, the whole goal of this is to get to the truth, find the truth of where you're at, and then that's where you can now bridge the gap of where you need to go. And knowing the math behind where you need to be creates, and it's not, Mark, you said this before, these are not gigantic changes, like small changes. You'd be surprised. You use a calculator like this and you just change the batting average from, say, 38% to 44%, and you improve your average loss by 1%. All of a sudden, bang, you're wildly profitable with just small changes. Just move on here.
Yeah, I'll just add to that. I think oftentimes, novices think, that the difference between, the seasoned professional and the amateur is this gargantuan mile-wide gap. And to Mark's point, it's actually, it's these very small attention to detail areas. And when it comes to risk management, this is precisely why you have to, again, to the probability distribution curve, you have to make the wall there. No one else is going to do it for you, meaning you have to be militant about not allowing those losses to get out of control, because it only takes, a few of those to really make a drastic negative impact on your performance.
So one of the big questions that I often get is, well, then how do we know what the expected gain is? If losses are a function of expected gain, how do we know what to expect? Well, and this is where we are in a very inexact science, right? Because we're dealing with assumptions now. And how well you make those assumptions is really important, because your risk is a function of that. So there's two types of assumptions, right? There's a theoretical, or what I call a theoretical based assumption, and then a result based assumption. A theoretical based assumption is an assumption that you come up with based on, whatever your analysis is. Some people use a swing technique where they measure a measured move, where they measure the top of the base to the bottom. Let's just say it's 20% decline, and they say, well, now it has a 20% chance to go to the upside. There's all types of ways we can come up with targets and come up with an expected gain based on a theory or an assumption. But the problem with an assumption or a theoretical based assumption is that it takes out one of the most important variables, and that's you, the operator, the person. Even strategies, we found that strategies that are mechanical and you get basically a buy and a sell, like a moving average crossover or something like that, people eventually stop following the signals. They don't execute it perfectly. You'll get a buy sell, and they'll get a whipsaw for a couple of times, and then they'll distrust the signal. So there is the foibles, the idiosyncrasies, the fear, the FOMO, all the things that come with trading are boiled into your results, your strategy. And this is why you have to have a very consistent application of discipline. Trading from these reference points. Again, there's so many reasons why reference points are important. And another one is so you're having a consistent environment that you can now count on that data being accurate and something that you can rely upon. And again, you don't have to know what hand aces are gonna win, or what trade is going to be a 15% winner or a 10% winner. What you need to figure out is approximately what you're going to average on the winners and approximately how often. Once you come up with that number and you can get a fair idea of what that number is going to be, the loss side becomes a mathematical equation. But in this example here, if we were to make that loss decision based on a theoretical based assumption, which we're going to call it, say, well, 20%. Technical analysis, we're using a 20% target. So we use a 10% stop, right? That's 2-to-1. We're going to cut our loss. We're going to make our odds 2-to-1. But in fact, even in those environments where you get those stocks that go up, you cut that off. You sell early. You have a tendency to sell, and you only average 10%. Well, now to get that same 2-to-1, you'd have to use a 5% stop, but you'd be using a 10% stop based on this theory. But in real life, that's not really what's happening. So what I do is I use my own results, and I try to be as consistent as possible and optimize my strategy so those results become very reliable. And it takes time to get to that point where you're going to get those reliable results. But you will. And even when you don't have a reliable strategy, let's say you're all over the place, you're still going to produce a result. All right. And I assure you that whatever you're doing, that result will be at some point over a number of trades is going to be pretty consistent. You'll sort of fall around that same number consistently because, again, it encompasses you overriding the strategy as well. So now, as that number improves, you're going to try to optimize that number, obviously. Over time, I've gotten to a point where I can't seem to increase it by a whole lot. And maybe I'm not optimizing it, it to the fullest extent that I could, but I'm optimizing it to maybe my fullest capability of how I run my strategy or with my own comfort zone. So that number's become very reliable for me of what my upside number is. And now I can set that stop, and I can know what I need to where I need to be on the risk side. With it's just a mathematical equation at this point. I don't know if you have anything to add before I go on. We'll go on to the next slide here, Mark. We're going to change gears a little bit.
No, yeah, go ahead. And this is it's all going to continue to sort of flow together here.
Yeah. So again, we're going to slice these numbers in a couple more ways. I want to show you how losses and how this win-loss ratio, all right, and thinking in terms of sometimes things are counterintuitive, and even when you raise your upside, right, your expected gain. Let's just say as a short-term trader, your expected gain, you've been averaging 4% gains. So you want to get that 2-to-1 ratio. So you're cutting your losses at 2%. Okay, if we're going to assume you had a 40% batting average, all right, somewhere around what Mark said that he runs at, a 40% batting average. If you were to do 10 trades with those numbers, you're getting 4% on your winners, losing 2% on your losers. Over 10 trades, your ROI would be 3.63%. You'd make about 3.5% on your money. Okay, so now common sense would say, okay, well, if I move to 8%, well, then I got to cut my loss at 4%, right? To maintain that 2-to-1. Absolutely. So now we move up to 8 and 4, and we make 6.49% on 10 trades. And as we move up here, we're going to keep maintaining that 2-to-1. So you might think, well, then if that's the case, then this would apply even if I was a long-term investor and maybe my average gain was 80%. I can take bigger losses, right? Not necessarily true. That's not true. So once you get below a 50% batting average, when you fall below 50%, what happens is, and you're going to fall below 50% at some point, or even maintain below 50%, as Mark said, his long-term average is below 50%. So what that means is that there is an optimal level of risk versus reward. You can't just increase proportionately, meaning that if you get into a volatile environment or a volatile stock, you can't just increase the loss. The loss still has to be capped. And let me show you how this works. So this is really, really important stuff. Not all your ratios are created equal when you fall below 50% batting average. And there's a couple reasons why this is important, but let's first just look at the math. So if you're at 42.21, where now it's still your 2-to-1, you can see it here, it's a little bit small here, and you're at 40% batting average, you're actually losing a little bit of money. You're just below break even. Step it up to, you go up and almost double it to the 80-40. Now you're making 80% on your winners, losing 40%. Still 2-to-1, right? So you should be making money? No, move over to the right here. You're gonna lose 51% of your money in 10 trades. How is that? I'm making 80%, I'm losing 40%, because losses work geometrically against you. So even if you raise your gain proportionately, you can't just make the loss bigger. You have to actually make the loss smaller. You have to truncate the loss for the volatility. So the general rule is that the more your batting average falls below 50%, at 40%, 10 trades at 80-40 you lose 50% of your money. But if you step that up and you go to 90-45 and you increase that downside to 45%, you widen that, you would actually lose more money. So there's an optimal level where any less, any more, you make less. If you have a smaller ratio, you make less. If you have a larger ratio, you make less once you fall below 50%. So the reason why, and I'm going to skip a slide here, I'm going to go from 436 to 437, and then we're going to go back to 436. The reason why, and what this means, is that what happens a lot of times when people experience volatility, and so they use a stop loss, and then the stop gets triggered. Let's just say you put an 8% stop. It goes below, it goes down 15%, then turns around and rips higher, right? And you're going, oh man, if I should never listen to Mark Minervini and taken an 8% stop. If I just held this, I'd still be in the trade. So you say, well, you know what? Things are a lot wider and more volatile. I'm going to increase my stop. Well, at some point, you hit a point where even increasing it proportionally to your upside is not going to get you anywhere. Matter of fact, you might be losing money even increasing proportionally. So when you get into a difficult period like we are now, and you're getting volatility, first of all, you definitely want to be off margin, because that's going to increase all this, the upside as well as the downside. But the main thing is, what you have to realize is that you need to actually cut your losses even tighter, not widen them. So you start with this maximum loss, that I'm telling you, and we're going to get into that in a little bit more. But as volatility increases, the last thing you want to do is increase your downside, which is that's a sort of a natural tendency. That would be your normal, common sense would say, well, I'm going to increase the downside proportionally, I'll still be okay. No, you actually have to tighten it up. Mark, in a very volatile environment, what are the things that you do to account for the volatile environment, to compensate for the volatility?
Yeah, three things. One, trade less, well, trade smaller, trade tighter, and trade less frequently. And this is, to Mark's last point, precisely the opposite of what a lot of folks do, and even a lot of professionals, will say things like, "Oh, just widen your stops." And if this section of the program doesn't teach you why you don't want to do that, it is precisely because these losses are working geometrically against you. So why do you want to increase the size of them? Is precisely the opposite of what you want to do, and also why. We're going to get to one of the other slides that shows the bigger the drawdowns, because the harder they are to come back from. So you want to, the one thing, remember from earlier, what do we have control over? We have control over that loss. So when things are not going well, you need to tighten that up, not loosen it.
Right. And while I'm showing you here a little bit tactically of what needs to be done, the big goal right now for me is to convince you and to show you why you need to draw that line in the sand, like I did after I ran those numbers and realized that I adjusted the loss, and all of a sudden my performance got so much better. And by the way, since I did that, I never had a down year from that point on. I have not had a down year, not one single year since I drew that line in the sand. Now, that's not the only reason why. There's other things skills that have to be developed, but that is the main reason. Without that, no matter what I do, is going to be sabotaged. So while there's some tactical things we're talking about, this is a mindset, and this is a risk first approach, where what I'm trying to convince you of is you have to draw a line in the sand, and that has to be in stone. Right? You're not. People say, well, how about if it goes down intraday? If the stock's down 20%, and you have an 8% stop, are you going to wait till the end of the day to see how it closes? No, of course not. But if it goes down 20% intraday, what if it doesn't come back and it goes up? Now I moved past that left side, and I'm taking that risk of having that outlier to the left. I got to wall that left side off, right? So let me show you another example to bring this point home, to show you that no matter how you slice and dice numbers, risk losses work geometrically against you. And even if you have equal reward, it doesn't pay for it. It doesn't pay for the risk. You've got to have a ratio. You've got to be getting odds on your money. You always have to be getting odds on your money. So in this example, you've got a choice. I'm going to give you a choice to pick 9 different sets of returns over a 3-year period. So you can have 10, 10, 10, all the way up to 90, 90, 90, meaning that you're going to have 2 years. You have a 66% batting average, 67% batting average. Two out of 3 years up, 1 year down, equal percentages. All right. 10% increments spaced out from 10 to 90%, meaning that if you were to pick 10, 10, 10, well, year 1, I'd give you 10% on your money. Year 2, I'd give you 10% on your money. Year 2, it goes down by 10%. What would your return be on these various calculations, and which one would you pick? What's the optimal? What's the best number? Well, the best number is 30, 30, 30. That's the best one. Now notice that any less or any more, you make less. There's an optimal ratio, right? So, but the other thing to understand about this is that if you look at the returns, there is no good number. 30% a year. Now you think to yourself, well, I make 50% a year, then I make 50% and I lose 50%. How could I not be making money and doing really well? Or 30%, 30%, and 30%. Two times I'm making 30, only one time I'm losing, because losses work geometrically against you. You're compounding. So the best that you're going to do under any of these scenarios is 5.8% a year, which isn't even worth going into stocks. And so the lesson from this is that you have to be getting odds on your money. So now if you were getting 40% in year 1 and 40% in year 2 and losing less, now your return would be much better, right? Now you're getting odds. If you were getting 2 to 1, that would mean where you'd have to get 60% in year 1, 60% in year 2, you're getting 2 to 1 with a 67% batting average. You'd make a ton of money. Your return would be huge. So you have to keep your losses in check with your gains, but they have to be getting odds on your money. That's the lesson here. The other lesson is, and this is what you should go back again, get into the truth of your trading. And this is what I did. This all just is circling back to the very beginning, and where I looked at my results and seen that I was cutting my losses, but every now and then there was a 30 in there. There was a 40, there was a 50. There was a couple big ones. And those were just this one-time moment. There was a time where I remember with a company called 50 Off Stores. I was so enamored with the stock that I talked to the company. I talked to the CFO. Peter Lynch was buying the stock. I heard that he was at the company talking to the executives, and I fell in love with it. I already made money in it, and I traded it great from a big cup with handle in the 1990s. But then I fell in love with it. And I had this one-time moment. It came down, and I said, you know what? I believe in this company. I bought more, and I bought more, and I bought more, and it ended up causing a big problem for me in my portfolio. And I could tell you right now, when you have just this one-time moment, it's never just this one time. It's a slippery slope. Nobody has just this one-time moment. Nobody goes to the refrigerator when they're dieting and just takes one little thing of ice cream and only does it one time. Nobody cheats with smoking and has just one cigarette just this one time, or one drink. It's a slippery slope. It's a very slippery slope. And with trading, you've got to be 100% disciplined and resolute. Mark, how many times have you had a stock, blow through your stop or go down big, and you say, you know what, just this one time, I'm gonna hold this loss, and I'm gonna add to the position because I believe in the company so well, and I'm gonna just this one. How many just this one time moments have you had in your career?
Zero. One of the things we often say in our office that we enjoy is when people ask you, when do you break the rules? Because Mark always says, if you're breaking rules, you don't really have rules, or what I often say is, when rules become guidelines, they're not really rules, like, meaning if they're not set in stone, then you don't really have them. So absolutely. If a market goes through my stop, say on a gap, I am out. I don't wait around. I don't hope and pray. It's you follow the discipline every time.
Yeah, you can't have not even one just this one time moment. And we're gonna end with that too. Just remember, when I end, we're gonna end on that, why you don't have just this one time moment. So if you're having trouble with your trading, right? Any of us, if we're having trouble with our trading, this is all about getting to the truth, finding out what's going on, and then bridging the gap from where you are to where you want to be. So there can only be a few things wrong if you're having trouble with your trading. Either you don't have a good strategy, you don't have an edge, your criteria is flawed, or you've got great criteria, but the market is hostile. That's a perfect example for now. Breakouts are not working. Does it mean I can go and buy a stock that's set up perfectly and is breaking out of a nice VCP, and most of them aren't working because we're in a bear market. The market's hostile. Or the third would be, I'm not following my own discipline. I got a great market, I've got great criteria, but I'm not following the rules. And this is where your failures are going to stem through either faulty principles or faulty discipline. So we're going to give you the principles. We're going to give you the tactics, the techniques, the principles, show you exactly how to do it. But the discipline, that's up to you. That's up to you. And that's where I've got to build this case, because so many of you are going to hold a stock when it's down. Stock's going to go down. It's going to turn around and go back up. And maybe it happens a number of times in a row. And you're going to be like, why am I cutting my losses here? Might as well just hold this. This is Amazon. It's not going out of business. And then you're a dead man. Okay. You're walking dead. It's just a matter of time, and you will blow up. I give you a guarantee of that. When you get into that mindset, if you can't manage your risk religiously and you have these just this one-time moments, eventually you will take a big loss, and all your performance, you'll have mediocre performance over the long term, because these occasional disasters will kill all the progress that you've made. Just like if you own Amazon went up 80,000%. So you hold it for 80,000% for 20 years, and then you get a market like we have now, and you hold it down 50%. You didn't lose 50%. You lost 40,000%. Okay, so losses work geometrically against you.
Mark, I just want to add to that, the last slide too. I think it's really important that bottom trading failures, meaning, what's ultimately going to cause failure, is not a hostile market. So if you look at the difference between sort of the 1, 2, 3 and the AB, like right now, and what we often tell folks is, look, if you're having a tough time, it's either because, your criteria is flawed or the market's bad. Well, we know, not just based on history and Mark's performance and mine and others, the criteria is not the issue. So that if you haven't learned that to this point, it's not the criteria. So the only way you're going to fail in the long run is, again, either you're not following through in the discipline or you're arguing with the market. So staying disciplined is going to keep you in the game when the market is hostile. And that's precisely how, Mark, how many bear markets have you been through now, Mark?
I think this is my 9th.
And you're still alive. And this is precisely why these bear markets weed everybody out, because they have faulty discipline or faulty principles.
Yeah. And see, what we have to create, the goal of, or the job of a coach is not just to teach the player how to swing a baseball bat or throw a football. There's a much bigger job. And my biggest job here is to show you the tactics and the strategy. And that's what people come to these kind of workshops. That's what they want. Give me the tools. I want the tools. Show me how to do this, read charts, all this. But that's not what's important. That I would be failing as a coach if I gave you all the tools and let you leave with all the tools without giving you what's really important. That's 2 things. One is to convince you that you can do this. That's more important than anything. That's why we have leaders and examples, and that it's people that someone like myself who came from poverty and made it up through the ranks and built my wealth by doing this, make someone else believe this is possible. I can do this too. He did it, right? It wasn't some special person that was born with a special talent, and that's really important. And the other is to let you understand the truth as to what exactly you have to do and the discipline behind sticking to those tactics. The discipline behind it is what's most important, and convincing you of why you should do what I'm asking you to do. Because if you don't have a why, if you don't understand why and understand what the reasons are behind it, then you're not going to just blindly believe it unless everything's going well. When everything's going well, yes, you'll believe all my tactics. You'll say, yeah, they work. But when they're not working, which inevitably you're going to have periods where things are not working very well, that's where you've got to stay committed, and you've got to understand what's going on and how to navigate it, and to keep you in the game and to keep your confidence and still believe that you can do this, because this business will beat you up and beat your confidence up worse than anything, and will convince you that the end of the world is coming. A breakout is never going to work ever again. You can't do this. You're not smart enough. You can't handle it. You don't have the stomach for it. I mean, so many things will come when it's going bad, because there's this emotional pressure, and there's a financial pressure. The financial pressure, it's like a double-edged sword. Let me move on. I know I'm going on and on here, but in the sake of time, I got to move on. So by measuring your results and knowing all this information that we just talked about, your instrument panel, making sure you're flying the plane upright, understand the risk-reward relationship, the batting average, having a high batting average, understanding that math, that building in the failure, the small losses and building in the failure actually is empowering. It actually helps you to bulletproof your strategy. When you start to understand all this, your bell curve, where your gains and losses are distributing along that bell curve, what happens is you start making better and more accurate assumptions. Your loss cutting becomes more optimal, because now you know where you are on the upside, and your batting average, now you know where you need to be on the downside. And what it does is it improves your decision making in real time, because now when that loss pops up and you're in a trade and you start feeling unsure what to do, the math guides you. You know where you're at, and you know what needs to be done, not what you want to do, not what emotions are telling you to do, what needs to be done. So the next time that you're in a trade and you're about to make a trading decision. Let's say you're in a trade, it's moving against you, and there's a loss, and it's ballooning, and it's at 4%, it's at 5%, it's at 6%, and you've got this urge, you don't want to take the loss, you don't want to admit you're wrong, you don't want to lose the money. Ask yourself, how is this going to look on my spreadsheet? How is this going to look on my bell curve? Where is that? That thing's in 10% loss. It's going to be sticking up on that left side, and you got to live with it for the rest of your life on your bell curve. Okay, so this is where the spreadsheet makes its way into your trading, and it becomes a strategic tool. Very important. All right, let's move on. So we get a lot of questions about stops as far as, okay, so are you setting the stop based purely on math? Because we talk a lot about math, and then we talk a lot about charts too, on where the pivot is, and if the pivot fails and so forth, and the bottom of the base of where to set these stops. So there's two types of stops. There's a technical stop where you're going to set it based on where the chart sours. So maybe you use the low of the pivot, the low of the base, wherever your pullback, you're pulling back to a certain moving average, whatever it is, it would be a technical stop that you're using the price action of the chart as to tell you when to get out. Well, then there's the mathematical stop, the pure mathematical stop, where you get to a point where, mathematically, I can't take any more loss here because my gain doesn't pay for it. My average gain is 10%. I'm at a 9% loss. It's heading towards my my average gain. That's something that just is mathematically not a smart thing to go beyond. So I've got to cut it at that mathematical level. So mathematical stop would be, I know I'm getting 10% on average on my gains. I'm right 50% of the time. I want a 2-to-1 reward to risk. Well, I got to cut my loss. I have to average. My losses have to average at 5%, right? That's another thing too. Remember, it's where you average. It doesn't mean that you make a hard line in the sand and say 5%, that's where you want to average. Whatever your maximum is, and we're going to talk about this in just a second, wherever your maximum is, it's always going to be less than that. You're always going to average less than that because that's your max, and you're going to take losses that are less than that, so you will average less. So now the goal is to use the risk, okay, as actually a selection tool, as part of the selection process. So that's what we call backing into risk. So when I look at a chart, and one of the reasons why we're going to have this tightness on the right side is not only because it creates this explosive potential from a supply-demand imbalance, which is the most important reason, but again, it creates that reference point, and where I know what's normal and what should be abnormal. And the tighter the price is, the more the abnormal activity will stick out and get me out of the trade and tell me, hey, technically this isn't working at a mathematically acceptable level, right? Because now if that right side is 2%, and I'm saying, well, technically, the bottom of that, of that pivot point, that's where this trade sours. Well, then I only have 2% risk, as opposed if the trade's all over the place, it would be normal if it went down 20% and hasn't even gotten to that low yet. So I'm going to back into the risk. I'm always backing into the risk. These are a couple examples I'm going to show you here. And what we call this trading near the danger point. This actually goes back to Livermore. Livermore in the 1920s and 30s, he talked about trading near the danger point. And that just meant trading close to your stop, right? Backing into the stop and making that stop as tight as possible, but bringing that into that math into the decision, the selection, and the charting, the decision of selecting the stock. In this particular instance here, you can see stop here is at the low of this little pullback here. And this is basically just a little, you had a gap here. This is playing a continuation from a gap, from a little VCP. You had a little cheat area, little pullback buy turning up here. I was buying this right here. I think this was the Arctic one that makes the forerunners, if I'm not mistaken.
Yeah, I remember this.
Yeah, I don't have the name here, but I think that's what it was. So now I'm trading close to the danger point where I'm mathematically pretty, not too far away. This isn't like this is 20% away to the bottom of this pullback here. We had a nice gap here. If this is really this strong, this low should hold. The stock should go, right? So now I've married the technical stop with the mathematical stop. Another one was motivation. This is one that I actually missed. It came out over here, and then it based for a little while, and I had not traded it here or here. And then finally, when it moved up here, I was looking back going, wow, I had a couple opportunities. This thing's really acting great. I decided to buy it on a pullback, which again, natural reaction. Everything just builds on what we previously talked about. This pulls back pretty naturally. We get, I don't know, 1, 2, 3, get 4 lower lows. I'm looking for support right there around that 4th lower low, pulling right back to the top of the base, pulling right back to the moving average there. That's a 20-day moving average. Right there is where, if this stock's really under accumulation, it's so powerful, the buying should come in relatively soon. So I'm getting a really cheap look here. I'm getting a really, a cheap trade because I'm trading right near that danger point. If it comes below there, well, maybe I'll start reducing. If it comes down, gets into this area here, that's where the trade is starting to sour. So again, mathematically, it's a very small stop, but technically the trade sours at the same time. That's backing into risk. Actually, I think it's time to take a break. So we're gonna take a break, and then we're gonna get into more about risk management here. There's so much more to go on risk management, but we're gonna talk about position sizing. We're gonna talk about when we come back, progressive exposure, which is one of the most important topics or ways to deal with risk, in addition to stop losses and what we talked about already. So let's take a quick break. I'm sure you guys are your head is filled with a lot here. I think we're just taking 5 minutes here, and then we'll be right back.
Okay, guys, that was part 1 of 3 parts that will be encompassing the risk management section. So let's take 5 minutes here. I would suggest getting up, doing some jumping jacks, get the blood pumping. We'll be coming back with risk management part 2, progressive exposure, after a 5-minute break. 3 parts on risk management, 6 sessions for the entire day, but risk management is really 3 parts. So 5 minutes, we'll bring it back. Go ahead and take a break, and we'll see you in a few minutes.